couple of months ago, I was on CNBC. Actually, it wasn't on CNBC Network. I was on their website, cnbc.com, because the producers over at CNBC rarely invite me on their network these days. So instead, I've been relegated to their website. And I was on this program called Futures Now. And I got into an argument with a guy by the name of Scott Nations, who is a regular on CNBC. And we argued about interest rates and whether or not the Fed was about to raise them. And Scott's position was that it was a virtual lock that the Federal Reserve was going to raise interest rates before the end of the year. They'd probably go in September, but certainly by December. My position was that the Fed was not going to raise interest rates at all in 2015. And in fact, they may actually do quantitative easing 4 in 2016.
If price is truth, then, and the price in the futures markets is the collected wisdom of everybody in the world. If you look at Fed funds futures, they're absolutely a lock, according to Fed fund futures, for the Fed to raise rates by the December meeting. 75% likelihood they'll increase by December, and then the likelihood that they'll increase even more continues as you go out further in the Fed funds futures. So why is everybody else wrong and you're right?
Hey, Scott, if you want to know how it's possible for one person to be right and everybody else to be wrong, watch the rest of this video.
The market isn't reacting negatively enough to the housing data, which is only going to get worse. You know, we're not just going to have a hard landing, we're going to have a crash landing. You know, all the inventory that's on the market is going to continue to build, and eventually prices are going to collapse beneath the weight of all that inventory. And then you fast forward a few months or next year, and a lot of homeowners who took out adjustable rate mortgages, negative AM mortgages, interest only, as their rates start to reset and they have to struggle to make those higher mortgage payments, they're going to have very little incentive to do so when their house is worth a lot less than the mortgage they're trying to service. And so that's when you start to see the defaults, the credit contraction, and the price declines really kick into high gear. And then, of course, you know, when you see consumers who have to spend every last drop of money on their mortgage payment, that means they have very little money left to go to Home Depot or to go to, Walmart. So consumer spending falls off the edge of a cliff, and, there goes employment and the economy with it. So it's going to be a self-perpetuating spiral where the housing market and the economy both go down together.
Well, the number of people who have adjustable rate mortgages, according to the Federal Reserve, is actually quite small in proportion to the number of mortgages outstanding. Plus,
no, it's probably about 20. It's probably about 25–30%. And I think more importantly, if you look among the subprime market, and then if you look at the very expensive markets like California, you have a much higher percentage of adjustable rate mortgages. I think if you took a look at the total dollar value of all the mortgage debt, you'd find that adjustable rate mortgages represent a very high percentage.
Except they don't all adjust at once. They adjust over 1 to 7 years. So why are you so worried about what's happening in the short term? By 7 years from now, the economy will look a lot different. No doubt.
It'll probably be a lot worse. But, as they start to adjust, that's a lot of people with a lot of mortgages. That's a lot of real estate going into foreclosure. People cannot pay these mortgage payments. In fact, a lot of people bought homes with mortgages that they knew they couldn't make. Basically, they figured they would bail themselves out with the appreciation. When the appreciation is not there, they have no way of making these payments.
Okay. And joining us now, Peter Schiff, president of Euro-Pacific Capital. There's lots of optimism about the housing market in 2007. Many experts have called the bottom. But Peter, you say interest rates going higher at 07 means what to home prices?
Well, anyone calling the bottom in the housing market, including Alan Greenspan, it's just wishful thinking.
The economy is stronger than everyone thought it would be. The U.S. economy is not going to go off a cliff. The Fed might be able to slow the housing market down, but I think home prices are going to be a big time next year. So I disagree 100%.
No, in fact, the U.S. economy is not strong. All we're doing is borrowing money from abroad.
We're not going to get into that now. All right, what do you think about this link between rates and housing, Gary B?
Is there a gap? Is there a gap, Gary?
Is there a gap there?
No, I'll tell you what, Brenda, I don't think there is a link between the rates and housing. We've seen, it depends on what you're talking about. If you're talking about new home sales, existing home sales, I'm talking about median home prices. It's like a freight train. They just keep going up. They went up through the 70s. They went up through the 80s. The only thing that derails the housing market, Brenda, is high unemployment. We don't have that right now.
We don't have it yet.
As far as Peter's talking about, yeah, I've heard this. People aren't saving, and And yet, as we discussed on the first segment, household net worth, median net worth is at an all-time high, inflation adjusted. So I don't know where that comes from.
That net worth is all these phony inflated housing prices. Once housing prices start to come back down, the net worth is gone, but all the mortgages are still there.
Tobin?
You know, Peter, this is very good for selling newsletters, and I happen to be in the newsletter business, so we should talk after the show. But this is bumped for two reasons. Number one, as we all said, if you said, geez, American country doesn't save enough money, 80s, 90s, 80s, 70s, you can say it anytime. 1880. Yeah. We are a country that imports excess capital because other countries are bad users of capital. We're the best users of capital. That's why
we're not using capital. We're destroying it. All we're doing is consuming.
Peter, just start selling the dried foods.
Okay.
Would you? Come on.
Scott.
Of course there's a link between interest rates and housing. But if rates go up, it could slow housing. It won't kill it. Housing is bumping along the bottom. It is bottoming. That's the key. But interest rates are remarkably low historically and remarkably stable. And my guess is that they will be for the next several years.
You guys sound like the people who were calling for the bottom in the NASDAQ when it was at 4,000.
Hey, Peter.
Yeah.
You want to come back on the show?
Homes be worth more or less in 2007. Time to get more for your money. Ben Stein, Patricia Powell, and Mike Norman are back, and joining us now, Tom Adkins and Peter Schiff. Tom, what do you think?
You're going to see prices go up about 10%. Here's why. Because you're going to come into a regular, normal market, and in regular, normal markets, that's about what kind of appreciation you get. Why? I look at the hit that the housing industry took over the past year. You had oil prices that went up, which meant gasoline cost 50% more. You had the Federal Reserve over 2 years raise rates 300%. And still, the housing market barely took it at all. It became a 3% cut in price.
So your judgment is home prices up 10% in the coming year. Peter, what do you say?
Well, today's home prices are completely unsustainable. They were bid up to these artificial heights by a combination of temporarily low adjustable rate mortgage payments, by a complete, absence of any lending standards, and by speculative buying. And what's going to happen in 2007 is a lot of these artificially low ARM payments are going to be reset upward. You're going to start to see both the government and the lenders reimposing lending standards and tightening up on credit. And you're going to see a lot of the speculative buyers turn into sellers. And these sky-high real estate prices are going to come crashing back down to earth.
Mike?
First of all, I have no idea what Peter Schiff is talking about. I agree with Tom. I think they're going to be probably up to about 10%. What artificial lending standard are you talking about?
Well,
mortgages have been issued. We have a tiny default rate in the single digits, and that only applies to subprime. In other words, people with the lowest level of credit standard. By the way, the economy still is very strong. We have a 4.5% unemployment rate. GDP is growing. The demographics, in other words, family formations, all the things that factor into housing are playing in here, and that is why we have not had a crash.
What I'm talking about, people buying houses with no documentation of their income, putting nothing down,
what percent?
Let me finish.
Wait, let me finish.
Yeah, with no documentation, putting nothing down, getting negative amortization, interest-only mortgages. They're buying homes they can't afford. They're speculating on appreciation.
Interest-only mortgages there's nothing wrong with them because you're paying the interest, you're not losing money on it. But the key thing to look at is net income growth. If net income growth is going up and interest rates are staying the same and we have no inflation right now, there's no reason for it to go up, you're going to see prices go up again.
Yeah, a lot of people who did that made a lot of money on their return on investment. They made a lot of money.
Wait. Last word to Peter.
Most of the profits that people have in real estate are going to vanish, just like the profits in the dot-coms in 1999, 2000. It's a fantasy. People can't sell their house. The inventories are exploding all over the country. Houses are on the market for 6 months a year. There's no bidders. The prices are going to fall through the floor. You guys are deluding yourself.
We heard it.
65% of the subprime mortgage market, 65% of those bonds, of those mortgages where a guy stated income, no doc, negative AM, risky loans, 65% of those things are repackaged by Wall Street and rated AAA, the equivalent of sovereign debt of the best credit quality governments in the world. How can it possibly be that 65% of the subprime mortgages that are issued get a rating at AAA? How can that be? Well, the reason is Wall Street creates these tranches of CMOs, $1 billion worth of mortgages. And the way they structure it is they insulate the top 65% from losses by saying all the losses from interest and principal are going to go to these riskier tranches. The riskiest tranche, which represents 1% of the market, 10 million face, that risky tranche gets all the losses first. So that tranche has to be wiped out before any other tranche loses one dime of interest, let alone principal. Now, that particular piece of paper is rated BBB minus and yields about 7.75% right now. That piece of paper should be rated F, and it will go to 0, as will several other tranches above it. Right now, one of the big trades that is starting on Wall Street, and which I'm participating in, is shorting that tranche. A lot of the brokerage firms now are creating derivative instruments where you can do these credit default swaps, and you can bet on those things defaulting. Now, what's going to happen as more and more people put this trade on, the price of those bonds is going to start to fall. As the price of those bonds, those risky tranche bonds, falls, the yields are going to shoot up. When that happens, it's going to make it impossible for Wall Street to collateralize this debt because it's going to be too expensive. Rates are going to rise, and the bottom is going to drop out of the subprime market. And of course, the subprime market is at the margin determining home prices. It's these buyers who are lying about their income, who are overstretching themselves, who are coming in here, and it's been made possible through this credit market where the buyers of these instruments are somehow believing they're insulated from losses, and people were willing to buy these risky tranches. Once they don't want to buy those tranches anymore, you're going to start to see a big, big drop or a big rise in interest rates, and that whole market is going to shut down. Because all of a sudden, when the mortgage people who are buying these bonds from you guys, when they can't resell them because Goldman Sachs and Morgan Stanley won't buy them anymore because they can't sell them, then it's over. There's no more market. There's no more secondary market for these products. So as expensive as real estate got, right, that's how cheap it's going to get. People are going to be completely amazed at the prices that houses are going to be selling for in a few years. Amazed. Just as amazed as the people were when they saw their shares of stocks go from 200 to nothing or practically nothing. It's the same thing. It's the same dynamic because you're going to have lots of sellers. You're going to have very little buyers. You're going to have a lot of foreclosures. You're going to have a lot of developers going bankrupt. You're going to have a lot of speculators. You know, I know lots of people own 5, 6, 7, 8 houses. You know, maybe they've had negative cash flow on these houses. Their negative cash flow is going to get bigger because a lot of them are refinanced with adjustable rate mortgages. You know, I know people who own many, many houses, and when they qualified on their loans, they wrote owner-occupied. I mean, there are people that have 7 or 8 or 9 owner-occupied homes in different states. I mean, everybody is looking the other way at these speculators buying houses. But, you know, they're all going to come on the market. Look where we are here in Las Vegas. I mean, there are so many condominiums that have been built in this town that nobody lives in. Their lights are never on. I mean, they weren't even bought with the intention of living in them. Some of them are so small, it's like nobody would even want to live. But why would you even want to buy a condo in this town? Look at all the hotel rooms. And they're pretty reasonably priced. Why would you want to own a condo? Well, the only reason people wanted to buy condos was because they thought they can flip them to somebody else. But as this huge supply of houses comes back on the market from speculators who got caught, and a lot of people who are speculators are homeowners. Just because you own your home and live in it doesn't mean you're not a speculator. If you bought a house using an adjustable rate mortgage, knowing that you can't afford to make the payments when they reset, you're a speculator. If you bought a house planning on selling it in 2 or 3 or 4 years, you're a speculator. That's all you are. So we had rampant speculation in this housing market, much more so than we had in the stock market. But the bigger problem is how intertwined the economy and the housing market are. You should put the houses on the market, and if you could find someone dumb enough to buy it and someone dumb enough to finance the transactions, you should sell. The fact of the matter is, the economy hasn't been humming. All we've been doing is going on a consumption binge, just like the heroin addict. These numbers are false. All they're measuring is how much wealth we're dissipating, not how much we're producing. We're borrowing money from the Japanese and the Chinese to buy the products that they produced on credit. We're going to go through a painful correction. Anybody that thinks that we're going to go from such a wide, out-of-whack imbalance, and all of a sudden we're just going to turn a little switch and it's going to be like a little, you know, not a big deal, is fooling themselves. It's, you know, just like when people told me, when I said the NASDAQ's going to drop 80 to 90%, of course I was right. Oh, no, it's only going to go down 10% or 15%. No way. We are way out of balance. We're not going to have a little mild recession. This is a major economic contraction that's coming, and the real estate market and the mortgage market is right in the forefront.